Something fundamental has shifted in the global financial system. And if you're not paying attention, you may find yourself on the wrong side of one of the largest wealth transfers in modern history. I'm not here to alarm you. I'm here to prepare you. This isn't about sensational headlines or get-rich-quick promises. This is about understanding the forces that are quietly reshaping where wealth flows, who protects it, and who loses it. The signs have been building for years, but most investors are still operating under assumptions that no longer reflect reality. You might already hold assets positioned for this shift, or you might be watching from the sidelines, wondering if the opportunity has passed. Either way, what matters now is clarity, not panic, not FOMO. Clarity about what's happening, why it's happening, and what it means for your financial future. Over the next 25 minutes, we're going to walk through the structural changes taking place in the global economy. We'll examine the macroeconomic forces driving them, and we'll discuss how thoughtful investors navigate uncertainty without abandoning discipline. This conversation isn't for traders chasing the next short-term move. It's for people who understand that wealth is built and protected through cycles, not headlines. For decades, the financial system operated within a framework most people took for granted. Central banks controlled interest rates. Governments managed debt levels. Currencies floated in relatively stable ranges. Investors could rely on certain patterns: bonds for safety, stocks for growth, cash for liquidity. That framework is breaking down. We're not experiencing a temporary shock. We're witnessing the unraveling of a monetary experiment that began over 50 years ago, when the world moved away from sound money and toward unlimited currency creation. The numbers tell the story. Global debt has exploded to levels never seen in peacetime. Central banks have expanded their balance sheets by trillions. Interest rates, after a decade near zero, have risen sharply, not because economies are strong, but because inflation forced central bankers' hands. And inflation itself? It's not a temporary spike. It's the inevitable consequence of decades of currency debasement now colliding with supply chain fragility, energy constraints, and geopolitical instability. Here's what most people miss. This isn't just an economic problem, it's a confidence problem. Currency derives value from trust. Trust in institutions, trust in stability, trust that the money you hold today will have similar purchasing power tomorrow. When that trust begins to erode, not all at once, but gradually, then suddenly, people look for alternatives. That search for alternatives is what's driving the wealth transfer we're discussing today. The average investor is trained to think in terms of bull markets and bear markets, risk on and risk off, growth versus value. These frameworks are useful, but they assume the system itself remains stable. They assume currencies maintain their role as reliable stores of value. They assume central banks can manage crises without creating bigger problems down the road. Those assumptions are now questionable. Most people hear currency reset and think it's conspiracy theory. They dismiss it as fringe thinking reserved for gold bugs and doomsayers. But the truth is far more mundane and far more serious. A currency reset doesn't require a single dramatic announcement. It happens through 1,000 small adjustments. Inflation eating away purchasing power, interest rate manipulation distorting markets, capital controls limiting freedom of movement, and gradual shifts in which assets people trust to preserve wealth. We've seen this pattern before, not in the United States during our lifetimes, but in dozens of countries over the past century. Argentina, Turkey, Venezuela, Zimbabwe. Even advanced economies like Japan have wrestled with monetary distortions that fundamentally changed investor behavior. The difference now is scale. This isn't isolated to one country. The world's reserve currency, the US dollar, is at the center of this shift. And when the reserve currency wobbles, there's nowhere to hide in conventional assets alone. Here's why people misunderstand. They're looking for a single event, a crash, a collapse, a clearly defined turning point. But system-level changes don't work that way. They unfold gradually, markets adjust, narratives shift, and by the time the mainstream recognizes what's happened, the early positioning opportunities have passed. Let's walk through the specific forces reshaping the financial landscape. Not with jargon or technical complexity, but with straightforward logic. Governments worldwide have accumulated debt at rates that cannot be sustained through economic growth alone. The United States national debt exceeds $36 trillion. That's not counting unfunded liabilities like Social Security and Medicare, which add tens of trillions more. There are only 3 ways to deal with unsustainable debt: grow your way out, default, or inflate it away. Growth isn't keeping pace. Outright default isn't politically viable. That leaves inflation, the slow, hidden tax that reduces the real value of debt while punishing savers and fixed-income investors. For over a decade, central banks suppressed interest rates to near zero, distorting capital allocation across the entire economy. When rates finally rose to combat inflation, the consequences rippled everywhere. Collapsing bond values, stress in regional banks, higher mortgage costs, increased government interest payments. Now central banks face an impossible choice: keep rates high and risk recession, or cut rates and reignite inflation. Either path creates instability. Either path undermines confidence in currency stability. Every major central bank has dramatically expanded its monetary base since the 2008 financial crisis. Quantitative easing, the polite term for printing money, became standard policy. These trillions didn't disappear. They remain in the system, inflating asset prices and gradually eroding currency purchasing power. Look at any long-term chart of the dollar's purchasing power. It's a steady march downward. What cost $1 in 1970 costs nearly $8 today. That's not economic growth, that's monetary debasement. The world is deglobalizing. Trade relationships are fracturing, sanctions are weaponizing currency systems, countries are seeking alternatives to dollar-based settlement systems, not because they hate America, but because they've watched how financial infrastructure can be used as a weapon. This creates structural demand for neutral, decentralized assets that exist outside any single government's control. Perhaps most importantly, investor psychology is shifting. For years, any hint of trouble meant central banks would step in with more stimulus. Don't fight the Fed became investment gospel. But that playbook is exhausted. Central banks are trapped between competing crises. And investors are slowly realizing that the institutions they've trusted to maintain stability may not be able to perform that role much longer. When psychology shifts from trust to skepticism, capital flows change. And when capital flows change at scale, wealth transfers from those positioned in legacy systems to those holding alternative stores of value. None of this is unprecedented. History offers clear lessons about what happens when currencies lose credibility and monetary systems transition. In the 1970s, the United States abandoned the gold standard completely. Inflation soared, trust in the dollar wavered, and assets that couldn't be printed, gold, real estate, commodities, dramatically outperformed paper currency and bonds. Gold went from $35 an ounce in 1971 to over $800 by 1980, not because of speculation, but because people sought protection from currency debasement. The pattern repeated in different forms across different countries. Weimar Germany, 1990s Russia, 2000s Zimbabwe, 2010s Venezuela. The details differ, but the sequence remains consistent. Unsustainable debt, political pressure, currency creation, inflation, loss of confidence, capital flight to hard assets. The United States won't experience hyperinflation like Zimbabwe. Our situation is different, but the underlying dynamic, currency losing purchasing power, investors seeking alternatives, is playing out in slow motion. What's different now is technology. For the first time in history, alternatives exist that combine portability, divisibility, and scarcity without requiring physical storage or government permission. That changes the equation entirely. Here's the key insight from history. Wealth transfers happen at inflection points. When monetary systems transition, wealth doesn't disappear, it moves. From those holding depreciating currency to those holding scarce assets. From those who react late to those who position early. The question isn't whether this transition will happen. The question is where you'll be positioned when it does. Disciplined investors don't predict the future. They prepare for multiple scenarios. They understand that markets move in cycles, but system-level changes create opportunities that transcend normal cycle timing. They recognize that volatility isn't the same as risk, and they know that the biggest mistakes come from emotional reactions, not from patient positioning. Let's talk about probability. No one knows exactly how this plays out, but we can assess probabilities based on historical patterns and current conditions. What's the probability that central banks successfully navigate between inflation and recession without significant currency debasement? Low. What's the probability that government debt levels stabilize without inflation reducing their real burden? Low. What's the probability that investors continue trusting traditional safe havens as those havens fail to preserve purchasing power? Low. What's the probability that scarce, non-inflatable assets attract capital during a period of currency instability? High. Disciplined investors work with probabilities, not certainties. They position accordingly without over-leveraging or betting everything on a single outcome. They also understand risk management. Holding assets positioned for currency instability isn't about abandoning traditional investments entirely. It's about diversification that accounts for system-level risks most people ignore. Think of it this way. Traditional portfolio theory says diversify across stocks, bonds, and cash. But if all three are denominated in a currency losing purchasing power, you're not truly diversified. You're just holding different expressions of the same fundamental risk. True diversification means holding assets whose value doesn't depend on the stability of any single government or currency system. This isn't radical thinking. Central banks themselves hold gold for exactly this reason. Sovereign wealth funds diversify away from pure currency holdings. The world's wealthiest families maintain positions in hard assets across multiple jurisdictions. The tools for this kind of protection used to be available only to institutions and the ultra-wealthy. Now they're accessible to anyone willing to educate themselves. If you already hold assets positioned for this shift, whether that's gold, Bitcoin, or other scarce stores of value, the most important thing you can do right now is nothing. Not nothing in the sense of ignoring what's happening, nothing in the sense of not reacting to short-term volatility or changing your strategy based on daily price movements. You positioned yourself based on a thesis about long-term monetary instability. That thesis hasn't changed. In fact, it's strengthening. Yes, prices will fluctuate. Volatility is the price you pay for holding assets that aren't manipulated by central banks, but volatility is not the same as loss unless you panic and sell at the wrong time. The hardest part of investing isn't buying. It's holding through the periods when everyone around you questions your judgment, when mainstream media dismisses your position, when prices temporarily decline and fear creeps in. This is where emotional discipline separates successful investors from everyone else. Understand that the wealth transfer we're discussing unfolds over years, not weeks. There will be setbacks. There will be periods where traditional assets temporarily outperform. There will be headlines announcing the death of your position. None of that changes the underlying fundamentals: currency debasement, debt expansion, inflation pressure, and the search for alternatives. Your job isn't to trade these movements. Your job is to maintain conviction in the macro thesis while managing position size appropriately. That means not over-leveraging, not borrowing to increase exposure, not putting money you might need in the next year or two into volatile assets. Risk management doesn't disappear just because your thesis is sound. It also means continuing to educate yourself. Understanding why you hold something is more important than knowing its current price. When you truly understand the macroeconomic forces at play, short-term volatility becomes noise, not signal. Finally, resist the temptation to become evangelical. The people in your life who don't understand this shift won't be convinced by your enthusiasm. They'll be convinced, if at all, by results over time. Focus on your own education and positioning, not on converting others. If you're watching this shift from the sidelines, you might feel like you've missed the opportunity. You haven't. Wealth transfers unfold in phases. We're still early in this transition. The majority of investors haven't positioned for currency instability. Most institutional capital remains locked in traditional frameworks. And most importantly, the fundamental drivers haven't played out yet. They're just beginning to accelerate. That said, there's a difference between early positioning and late chasing. The worst thing you can do is panic buy assets you don't understand at prices that make you uncomfortable, purely because of fear of missing out. Instead, approach this methodically. First, educate yourself. Understand the macro thesis. Study monetary history. Learn why scarce assets perform during currency instability. Don't invest in anything you can't explain in simple terms to someone else. Second, start small. You don't need to bet the farm. Even a modest position in alternative stores of value can provide meaningful protection if the thesis plays out. Think of it as insurance. You hope you don't need it, but you're glad it's there if you do. Third, dollar cost average if you're concerned about timing. Rather than trying to identify the perfect entry point, accumulate gradually over time. This reduces the impact of volatility and removes the emotional pressure of trying to time the market perfectly. Fourth, ignore short-term price movements. If you're buying because of a long-term macro thesis, day-to-day fluctuations are irrelevant. In fact, volatility that scares others away represents opportunity for patient accumulators. Fifth, maintain balance. This isn't about abandoning all traditional investments. It's about adding a dimension to your portfolio that addresses system-level risks others are ignoring. Here's what you should not do. Don't wait for certainty. By the time everyone agrees this shift is happening, positioning opportunities will have passed. Don't wait for lower prices out of greed. Trying to catch the absolute bottom usually means missing the move entirely. And don't follow online hype or financial influencers promising guaranteed returns. The opportunity isn't about getting rich quick. It's about preserving and growing wealth through a period of monetary transition that will punish holders of pure currency and reward holders of scarce assets. Let's be explicit about the mistakes to avoid, because these are where most people destroy value even when their thesis is correct. Fear and greed are your enemies. When prices spike, greed tempts you to overcommit. When prices drop, fear tempts you to sell. Both destroy long-term returns. Emotional control matters more than intelligence in investing. Borrowing to increase exposure might amplify gains, but it can also force you out of positions at the worst possible time. Volatility is guaranteed. Margin calls are deadly. If you can't hold your position through a 30% drawdown without losing sleep, you're overexposed. Every day brings new narratives, new predictions, new reasons to buy or sell. Most are noise. The macro thesis changes slowly. Your position shouldn't change with every news cycle. Social media is full of people making bold predictions and promising wealth. Some are well-meaning but wrong. Others are deliberately misleading. Do your own research. Understand your own thesis. Make your own decisions. Any asset that can dramatically appreciate can also decline. Never invest funds you might need for near-term expenses. Never bet money that, if lost, would materially harm your life. Gains are taxable. Understand the rules in your jurisdiction. Structure your holdings appropriately. Paying taxes on gains beats having no gains, but planning ahead beats overpaying. Even if this thesis plays out perfectly, diversification matters. No single asset class, no matter how compelling, should represent your entire net worth. Balance isn't weakness, it's wisdom. Transitions are messy. There will be false starts, temporary reversals, and periods where it seems like nothing is happening. The path from currency instability to wealth transfer isn't a straight line. Paper declines aren't real losses unless you sell. If your thesis remains intact and your position size is appropriate, temporary drawdowns are expected, not reasons to exit. The landscape is evolving. New information emerges. Conditions change. Investors who stop educating themselves make decisions based on outdated assumptions. Let's return to the core question. What's actually likely to happen? We don't deal in certainties. We deal in probabilities based on historical patterns, current conditions, and the incentives driving key players. Central banks face a trilemma: control inflation, maintain economic growth, or service government debt. They can't achieve all three simultaneously. Something has to give. History suggests it's currency purchasing power that suffers. Governments face a political reality. They can't cut spending enough to balance budgets, and they can't raise taxes enough to close deficits. That means continued borrowing and continued pressure on central banks to keep rates manageable, which means continued currency creation. Investors face a dilemma. Traditional safe havens aren't preserving purchasing power, but exiting the system entirely feels risky. This tension resolves gradually as more capital shifts to alternatives. The probable path isn't dramatic collapse. It's slow erosion punctuated by periodic crises that accelerate the trend. Think of it like this. A currency doesn't go from trusted to worthless overnight. It declines in steps. First, official inflation moderately exceeds targets. Then, people notice everyday prices rising faster than statistics suggest. Then, the gap between asset prices and currency purchasing power widens. Then, alternative stores of value begin attracting serious capital. Then, the gap accelerates. We're somewhere in the middle of that sequence right now. The probability that this reverses, that governments suddenly embrace fiscal discipline, that central banks restore sound money, that debt levels stabilize, is low. Not impossible, but low. The probability that currency debasement continues and scarce assets outperform over the next decade, that's high. But high probability doesn't mean certainty. It doesn't mean no volatility. And it doesn't mean you can ignore risk management. Position for the probable outcome while respecting the possibility you're wrong. That's not hedging your bets out of fear. It's intelligent risk management. Step back from daily market movements and quarterly economic data. Look at the bigger picture. We're living through a monetary regime change. Not the first in history, but the first in most people's lifetimes, and certainly the first playing out in real time across global markets with instantaneous information flows. Regime changes create opportunities precisely because most people don't recognize them until they're obvious. By then, asset prices have adjusted and positioning opportunities have narrowed. This isn't about timing the next trade. It's about understanding the structural forces reshaping where capital flows and why. For 50 years, the world operated on a pure fiat standard, currency backed by nothing but government promises. That experiment produced unprecedented debt expansion, recurring financial crises, and gradual erosion of purchasing power. We're now entering a phase where the consequences of that experiment become unavoidable, not because of conspiracy or coordinated planning, but because mathematics and human nature have predictable outcomes. When debt becomes unsustainable, it's inflated away. When currencies lose purchasing power, capital seeks alternatives. When trust in institutions erodes, decentralized solutions emerge. This isn't speculation. It's pattern recognition based on how these situations have resolved throughout history. The wealth transfer we're discussing isn't about the rich getting richer or some nefarious plot. It's about capital flowing from assets that don't preserve value to assets that do, from depreciating currency to scarce alternatives, from those who ignore these forces to those who understand them. Where you end up depends on how you position now, while most people are still operating under old assumptions. So what does a thoughtful investor do with this information? You develop a framework for thinking about macroeconomic risk that extends beyond traditional portfolio theory. You acknowledge that currency instability is a real, underappreciated risk in conventional portfolios. You educate yourself about alternatives, not because they're exciting or trendy, but because they address risks your traditional holdings don't. You position appropriately, not with reckless concentration, but with deliberate allocation to assets that perform during monetary instability. You maintain discipline. Volatility will test your conviction. Market narratives will shift. Critics will be vocal. Your job is to tune out noise and focus on fundamentals. You manage emotions. Fear and greed will push you toward mistakes. Patience and perspective will keep you on track. You continue learning. This landscape evolves. New information emerges. Conditions change. Investors who stay educated make better decisions than those who set and forget. You resist the temptation to trade. Unless you're a professional trader with sophisticated systems, trying to time markets usually destroys returns. Buy and hold through volatility based on a sound thesis. You keep perspective. This isn't about getting rich overnight. It's about preserving and growing wealth through a period of monetary transition. That happens over years, not months. You maintain balance in life. Yes, this is important. No, it's not the only thing that matters. Financial health supports life quality. It doesn't replace it. And perhaps, most importantly, you don't let perfect be the enemy of good. You don't need to position perfectly. You don't need maximum exposure. You just need enough exposure that if the thesis plays out, you benefit meaningfully. That might be 5% of your portfolio. It might be 20%. The right number depends on your situation, risk tolerance, and conviction level. But some exposure is infinitely better than no exposure if this shift accelerates. Some watching this will be skeptical. That's healthy. Skepticism prevents foolish decisions, but distinguish between healthy skepticism and stubborn dismissal. Healthy skepticism asks, what's the evidence? What could I be missing? How does this play out? Stubborn dismissal says, this sounds crazy, so I'll ignore it. The skeptics will point to decades where the dollar remained dominant, where predictions of collapse never materialized, where alternative assets underperformed. They're not wrong about history, but they're making a crucial error, assuming that what worked for 50 years must work forever. Financial systems are not eternal. They evolve, they strain, they break, they transition. The question isn't whether change is possible. It's when it becomes probable. Consider what would have to be true for the current system to continue indefinitely without significant consequences. Governments would need to control spending despite political incentives pointing the opposite direction. Central banks would need to unwind balance sheets without causing market disruptions. Debt would need to stabilize or decline without inflation or default. Currency purchasing power would need to stabilize despite ongoing creation. Is that impossible? No. Is it likely? Also no. The skeptics also confuse absence of immediate crisis with absence of underlying problems. Just because something hasn't collapsed yet doesn't mean its foundation is sound. Structures can be unsound for years before visible cracks appear. By the time everyone recognizes the problem, it's too late to position advantageously. This isn't about being contrarian for its own sake. It's about recognizing risks others are ignoring and positioning accordingly. If the skeptics are right and everything continues smoothly, a modest allocation to alternative assets costs you some opportunity cost. If they're wrong, that allocation could make the difference between preserving wealth and watching it erode. Asymmetric payoffs favor positioning for the scenario most people dismiss. We've covered a lot of ground. Let's bring it together. The global financial system is under stress that most investors don't fully appreciate. Debt levels are unsustainable. Currency debasement is accelerating. Inflation is eroding purchasing power. And traditional safe havens aren't providing the protection people assume they will. This isn't prophecy. It's observation of forces that have been building for years and are now reaching critical mass. A wealth transfer is underway, from those holding pure currency to those holding scarce assets, from those reacting emotionally to those positioned thoughtfully, from those who wait for certainty to those who act on probability. Where you stand during this transition matters enormously for your financial future. If you already hold assets positioned for monetary instability, your job is to maintain conviction through volatility. Don't let short-term price movements shake you out of a sound long-term position. If you're still on the sidelines, your job is to educate yourself and position appropriately, not with panic or leverage, but with measured allocation based on understanding the macro thesis. Either way, emotional discipline matters more than intelligence, patience matters more than timing, and understanding the structural forces at play matters more than predicting the next quarterly move. This isn't about fear. It's not about hype. It's about recognizing that we're living through a significant monetary transition and positioning accordingly. The investors who prosper through this period won't be the ones who predict every twist and turn. They'll be the ones who understand the underlying forces, position early, and hold through the inevitable volatility. History is clear. Wealth transfers happen at inflection points. Monetary regime changes create those inflection points. And those who position before the shift becomes obvious always outperform those who wait for confirmation. You now have the framework to think about this clearly. You understand the forces at play. You know what disciplined positioning looks like. What you do with this information is up to you. Stay informed. Stay disciplined. And remember, protecting wealth during uncertainty isn't about bold predictions or perfect timing. It's about understanding cycles, respecting probabilities, and positioning thoughtfully for what's probable rather than what's certain. The shift is here. The question isn't whether it's happening. The question is whether you're prepared. Thank you for your time and attention. Stay thoughtful out there.